Good afternoon. For the CME, this is Chris Robinson, Managing Director of Ags and Commodities at TJM Brokerage, also the publisher of the Robinson Review. Okay, today is the 10th. We had our USDA report, much awaited, and it did not fail to produce some fireworks. Long story short, the report was bearish for corn, kind of friendly for soybeans, and slightly bearish for wheat. But the market really had a repricing event today. And I'm just going to focus mostly on corn. In the last 3 weeks, corn had made a nice rally back. After a $1.20 sell-off this summer, we had rallied back 45 cents in 3 weeks. It looked like we were headed back possibly to north of $4. A lot of farmers, producers, even a lot of end users were worried that we were not going to have a crop, it was not going to be there. The numbers came out today in the USDA, even though they had made the crop smaller, it wasn't as big of a reduction as the trade was anticipating. That's really what it came down to. The carryout was about 1.9, the average guess was about 1.6, so about a 300 million bushel difference. That's all it took. And lo and behold, in the last 2 days, between yesterday's high and today's low, out of that 45-cent rally, we've given back about 20 of it. And I can't stress that enough. These report days are critical. Doesn't matter what your opinion is, bullish or bearish, it's usually a good setup for a strangle. A strangle is a type of hedge or a trade where you buy a call at one strike price, you buy a put at a different strike price, and then if the market moves, one of them pays off, and that certainly happened today. And we'll see. There might be another 5 to 10 days moving forward where we need to work through this USDA data. But that's the number one thing, a sharp correction. And again, these trade days represent opportunity. They also represent risk. But if you're looking for markets that move, it's nice to have these specific points in time that USDA provides us, you know. So that's it about covering what happened really in the USDA report. You can get more in depth, but at the end of the day, certainly a repricing event in corn. You know, we'll see what happens in the next 2 to 3 weeks. Finally, if you're looking for a more bullish story, you got to take a look at cotton. December cotton, you know, we had a horrendous $20 sell-off back from April to the August lows. The market was coming this close to 10-year lows, and as we've moved forward here in the last several weeks, you know, we've had about a 7-cent rally. Take a look at that chart if you're looking for sort of a technical type of trade. Cotton can be very, very thin, very, very dicey, but right now you're in a situation where December cotton is hugging this little bit of a trend line. It's a little bit of a bullish trend line. If that keeps going, you know, it could prove to be a problem for the managed money out there right now. Managed money commitment traders, they're short a chunk of cotton. That means they're out of position. And cotton held up pretty well today despite all the negative moves on the rest of the markets. Also, cotton is kind of your surrogate China trade. You know, if we ever did come to an agreement with China, the three things that would move the most would probably be obviously soybeans, but cotton as well as copper. So watch that cotton chart. It might, you know, if you're looking for a bullish story, again, I just talked about the bearish move today in the corn. The flip side, looking for a bullish story, take a look at cotton. That's about it. This is Chris Robinson. If you're looking for help with your hedging or trading, look me up online.